PDD Holdings delivered a completely polarized Q2 2026 print today. I mean, it was a top-line miss paired with a bottom-line beat. Revenue came in at $16.5 billion, missing consensus, but adjusted EPS actually beat estimates at $2.85. Management offered zero numerical guidance, but they did issue a pretty brutal qualitative warning that margins will compress indefinitely.
Right, and the stock reaction was just wild. It popped pre-market on that EPS beat, but then sharply reversed during the earnings call. It ended up closing down nearly 2% on just massive institutional selling.
Yeah, which is exactly what we're unpacking today in this deep dive because, imagine sitting on a $63 billion cash pile, beating your profit estimates, and watching Wall Street just completely dump your stock anyway.
Exactly. I mean, the sell-off wasn't really about the raw revenue number. It was entirely about the engine driving it. When you actually look at the segment breakdown, you realize we are watching a permanent structural shift in this business.
Okay, so break that down for us. What exactly shifted?
Well, their traditional cash cow, which is that high-margin online marketing, it barely grew at all, like maybe 3.48%. The only real growth engine right now is transaction services, and that is heavily driven by Timo.
And even that missed expectations, right?
Right. Even that missed by over 6%. So it just confirms they're moving away from a high-margin, asset-light domestic model. They are building a lower-margin, fulfillment-heavy, global beast instead.
So it's like they were running a highly profitable digital toll road, and now they've just suddenly decided they need to physically pave every driveway in the world themselves.
That is a perfect analogy, actually. Yes, they maintained a 26% operating margin this quarter, but management practically shouted on the call that this era of profitability is over.
Right, they're deliberately sacrificing short-term profit to build out physical supply chain infrastructure. But wait, I'm confused, though. If you have $63 billion in cash, why intentionally tank your own margins?
Well, because they feel like they have to.
But why not just throw retail investors a bone with a share buyback while you build this infrastructure? I mean, it feels agonizing to watch them just sit on that cash.
I get that, but management doesn't see this as a quarterly earnings contest,
Yeah.
They really view this as a war for survival. They have two massive walls closing in on them right now.
Okay, so let's get into the risks then. What are those walls?
Let's look in Europe first. So in July 2026, the EU is hitting them with new customs duties on low-value shipments. Up until now, Temu has relied super heavily on the de minimis loophole.
Ah, right. Just shipping cheap packages directly to consumers tax-free.
Precisely. So with that loophole closing, their fundamental cross-border advantage basically vanishes overnight. To survive that regulatory hit, PDD has to spend aggressively to build localized warehousing.
Oh, wow. So they have to onboard local merchants inside Europe, too.
Exactly. They have to physically move the supply chain across the borders to avoid those tariffs. Yeah. And honestly, that is just incredibly capital intensive.
So international expansion is getting vastly more expensive for them, but they aren't doing this in a vacuum. I mean, they are also fighting a brutal war at home.
Yeah, they definitely are. And that actually explains their massive 100 billion RMB ecosystem investment. Domestically, Alibaba and JD.com are really forcing PDD into a corner.
So to fight back, PDD is heavily subsidizing rural logistics.
Right. They are essentially eating the cost to ship items to remote villages just to starve JD.com of market share. And on top of that, they're pouring capital into a first-party brand initiative.
Basically paying up to lock down premium products so consumers don't flee to their rivals.
Yeah, exactly.
So to bring this back to you, the investor listening, is management basically using shareholder money to subsidize cheap goods for consumers and fight off regulators? Like, are you just accepting dead money for the next 2 years while PD attempts this huge metamorphosis?
Well, that is the ultimate bull versus bear debate right now. I mean, bulls look at their forward PE multiple and argue that this margin compression is already priced in.
Right, and they have that massive cash safety net to catch them.
Yeah, but the bears look at that massive institutional selling and they see a company under immense regulatory fire internationally. Plus, they are facing a totally saturated market domestically.
And they're led by a management team that absolutely refuses to return capital to shareholders, which is tough.
Right. I mean, it is an incredibly long, expensive investment cycle they are entering.
A very heavy transition, for sure. Make sure you follow this feed for our daily earnings coverage so you never miss these massive structural shifts in the market.
Absolutely.
But let's leave you with a final thought to mull over. If a juggernaut like PDD is forced to hoard over $63 billion in cash just to survive global regulatory headwinds and domestic supply chain rebuilds, does this signal that the era of hypergrowth for Chinese e-commerce is officially dead? replaced by a capital-intensive war of attrition.